The AI debate. Barclays referencing delays in AI models, and I want to use that as the perfect setup for comparing Coreweave to Palantir. Now, this is an insane setup because you have two stocks that have absolutely been killing it. NVIDIA has been your built-in put option for Coreweave. Every time that sucker goes under $40, I send an alert to my course members in our alpha report. I'm like, Coreweave under 40, NVIDIA's gonna be buying this sucker. It's gonna skyrocket. And it just keeps doing it over and over and over again. It's one of the easiest trades. Mind you, if you want to be part of the alpha report, you could join over at meetkevin.com and you could try it for 30 days, see if you like it, see how it works for you, or you could sign up for longer if you want to. The price will be going up this month. Go check it out and lock in your price before the price goes up. So when it comes to this AI battle, Barclays has a new piece out where they suggest that artificial intelligence progress is slowing at the same time as hallucinations are increasing. They reference the delayed AI model releases from Meta and OpenAI as potentially impeding return on invested capital and ultimately slowing the pace of data center demand. Now, they remain cautious on AI data center buildout. And again, we're going to be talking about how this affects Coreweave and Palantir, but it's worth noting why Barclays started talking about this. Barclays started talking about this because they referenced the Wall Street Journal piece on Meta delaying their flagship AI. In the Wall Street Journal piece, we had a quote that says, company engineers are struggling to significantly improve the capabilities of Meta's behemoth large language model, leading to staff questions about whether improvements over prior versions are significant enough to justify public release. Mind you, this aligns with the theory that I've discussed on the channel since 2023, that we're seeing the first major exponential step up in neural nets. But mind you, we've been using neural nets in our real estate business since 2018 and sort of our wedge finder. And yeah, neural nets have gotten better, but they really went mainstream as AI in an encyclopedic manner through GPT. The problem was, and I mentioned this, is that in 2023, is that we might end up hitting a plateau very soon, a lot sooner than people think, because what we've done is we've created this really cool encyclopedic AI, but are we really going to go exponentially to AGI, artificial general intelligence, thereafter? Like, are we on this exponential explosion of AI? In my opinion, no. We've taken a huge step forward, but now I think we kind of rest at that encyclopedic data stage. And so far, these delays of models from OpenAI, the Barclays piece, the Meta delays, they kind of align with my thesis. And this isn't me trying to confirmation bias here. It's just trying to say, I had a thesis, and it appears to be playing out right now. Now, does that mean bearishness on Coreweave or Palantir? No, it actually might mean bullishness, and I'm going to break down the benefits and risks to this in just a moment, and that's exactly why we're going to talk Palantir versus Coreweave. But you've got to have a little bit more of a background here. So Barclays argues that one of the reasons we're seeing Microsoft shift their data centers to leasing data centers is because Microsoft wants to de-risk from exactly what Meta and OpenAI are potentially seeing as well. And so if Microsoft builds fewer data centers, guess where that business goes? It goes to businesses like Coreweave. Microsoft now also laying off about 3% of their staff. Now they're branding this as middle-level managers getting fired, but at least based on what I'm hearing on the ground, could be wrong, but what I'm hearing on the ground is that that is false. That middle-level managers aren't getting laid off. That maybe some of them are, but it's not just exclusively middle-level managers, that a lot of other people who aren't in management positions are getting laid off, and this is just Microsoft's way of trying to save face as they pull back from some of their broader expansionary bets, maybe because they're starting to see some of the softness in how rapidly things are progressing. So we kind of put together what's happening at Microsoft with what Barclays is seeing in Meta, in OpenAI. All of this sort of aligns with a slowing in that AI curve. Also, Worth noting that Barclays not only is a little bit bearish or cautious, they say it on this space, but they also say it's, quote, reasonable to question whether Meta's recent increase to their 2025 CapEx guidance was because there's more opportunity or because AI developers are struggling and therefore you need more investment into CapEx to try to help those developers. But then comes the question of, are you throwing more good money after progress that just isn't being made? So in the near term, if you, like how this actually affects your money, which I always like getting to that bottom line, is in the near term, that actually sounds really good for like Coreweave and NVIDIA, right? Because it's like, all right, y'all need more chips to kind of get where you're going. Cool. NVIDIA will supply them. AMD will supply them. Supermicro will help build the racks. Dell will help build the racks. And Coreweave will lease them to you. This sounds bullish, but what does it mean in the longer term if we get a substantially lower return on invested capital and eventually some of those investments end up being either fruitless or cut? Something to pay attention to. So this is a great setup for getting into Coreweave and Palantir. So understand these companies are very, very different, but they're both related substantially to artificial intelligence. Coreweave right now sits at about $3.1 billion in current assets, including restricted of about $600 million of cash that they probably have allocated for construction. The problem with Coreweave is they have about $6.5 billion of current liabilities as of March 31st. Their IPO raised them about $1.5 billion, so that raises them, to current capital of around 4.6, and they're trying to raise more debt, another $1.5 billion of debt, which makes sense because right now Coreweave does not have enough money to pay its bills. That doesn't make Coreweave a bad stock, and there's a reason the stock is actually going up, and the stock going up is the perfect opportunity for Coreweave to honestly sell some shares so they can clean up their balance sheet. Their balance sheet has some near-term problems. Now, that's not to say, again, it's a bad company. It's simply to say that right now they don't have enough money to cover their bills, okay? That said, Coreweave's business model is one that depreciates a lot of their assets. So when they go build a server rack, they take massive depreciation. So when you look at their actual numbers and their actual earnings, it looks like they're operating at a loss. They have very little sales and marketing expenses, which is, both a good and a bad situation. Usually when you have really low sales and marketing, it means you don't really have to market yourself, like you've got business coming to you, which is great. But what happens when that business stops showing up? Are you going to have to really ramp up your sales and marketing expenses because all of a sudden you're not able to attract business like you were? So that's a potential downside in the future as well, is that if they have to pick up marketing expenses, their losses, might actually be substantially larger than what they are today. Right now, they've got so much business, they don't have to market themselves, which makes their margins look better, especially when you add back in depreciation. So without depreciation back in, their operating profit is about negative $27.4 million. But when you add in depreciation of $443 million, technically they had profits of about $415 million. That's based on them depreciating $14.2 billion of plant, property, and equipment. It's actually not bad, because if you think about it, that's $415 million on 14.2 bill. That's like a return of 11.6%. That's like nice rental yield if you think about it, right? Now, if you subtract the interest they're spending, about $263 million, you're only down to about a 4.2% return on your investment, on their yields from their server stack. Not bad. It's a new company. They're growing like crazy because they're building infrastructure, building, taking more depreciation. Everything from their earnings call, very bullish. Okay, they've got so many people lined up to rent more business from Coreweave. All of that, very good. So I actually really like the Coreweave numbers outside their balance sheet and outside the sales and marketing risk of the future. I really like their numbers. I think they are very profitable, and I think they're killing it in terms of pipeline. And I think they'll solve their balance sheet issue, especially with how high the stock has run now recently. That said, the biggest risk to Coreweave is actually the opposite risk that Palantir has. We'll talk Palantir in just a sec, but listen to this. Coreweave's biggest risk is becoming the industry bag holder. See, think about them as the person that everybody dumps the assets on. Let me explain this a little differently. NVIDIA sells a lot of their hardware to companies like Coreweave, which now it makes sense why NVIDIA wants to prop up Coreweave and disclosed over a 6% stake in the business, because as long as Coreweave keeps buying, NVIDIA can keep selling, which bodes well for NVIDIA earnings coming up, obviously. This bag is really, really profitable right now, but is it potentially a ticking time bomb if companies like Meta go, damn bro, everybody's got a commoditized LLM, we're not making progress on like the GPT 5.0 levels, we're kind of stuck in agentic AI, agent style AI, or self-querying AI, which is what we call reasoning. But let's be real, it's basically just trying to do the prompting work for you, right? And it's like, okay, I think they want this, let's prompt like this. The new versions of GPT and other LLMs do this very well for you and certainly demand a lot more inference compute. And this is hopefully what keeps Coreweave propped up. But when it comes to training, if we see a CapEx slowdown in training or just a shutting down of some models in favor of others, we're really going to be left with a whole lot less compute than maybe what we're building out for. Now, of course, that could end up hurting NVIDIA in terms of chip sales in the future, but it also hurts a company like Coreweave. I mean, we saw Jensen himself say, hey, I can't even give away some of my older chips anymore. They're basically worthless. He kind of caught himself on that. He's like, maybe I shouldn't say that. But it's true. When you come out with new chips, but then there's potentially less demand for as rapid of growth as we're seeing now, some of that growth slows down in the future, Coreweave might end up having assets that are worth substantially less than what they're worth today. So there are risks that Coreweave becomes that industry bag holder of lower grade chips or of chips that are worth less in the future because NVIDIA starts dropping prices for their product, or there's just not as much demand and that growth curve starts slowing down a lot for Coreweave, where companies like Microsoft say, hey, we just don't need to lease as much from you anymore. Now all of a sudden Coreweave's built out the infrastructure for companies that aren't necessarily using it anymore. We'll see. For now, I like the numbers and things are looking great and I love the earnings call, but I do see risks here. Now, this is why I like comparing though to Palantir. See, Coreweave's great, very capital intensive though. 33 AI data centers in the US and Europe, contracted out to probably about 4x the build out, which means they're purposefully taking it in the margin right now to expand faster, which is dangerous because you're burning more margin right now to overbuild because everybody wants your building. People are like, please, Coreweave, 4x. They have contracts signed for 4x. This is why they don't have any sales and marketing. But what happens when you build it all and then demand shrinks and now you're like, crap, now we got to market, right? Okay, you get the idea. I just want. Hey, quick reminder, if you want to earn a 5% yield plus all of the upside in my real estate startup, we are offering a non-accredited investor round where we will pay you a 5% yield plus you get all of the upside in the stock when your stock converts in the future. It gives you an opportunity to diversify away from rich stock market valuations, diversify away from most tariff risk, diversify away from the craziness of the treasuries market, especially with these Moody's downgrades. You diversify into fixer-upper real estate, which is what I believe I do best. This is my baby. I call it my little Berkshire Hathaway. Now, maybe I'm biased, but I've got over $5 million of my own money invested into this business, and I'm so excited for what I think we're going to be able to do with this business over not just the next years, but the next decades. So if you want to invest in my real estate startup, go to househack.com and know that I will do everything for this business in my power to make sure we can do the absolute best that we can. Make sure to read the solicitations and disclosures on the HouseHack website because there is risk with every investment. To give you some of those numbers, Now, so far, the total addressable market, TAM, is that these server centers, data centers, could be somewhere around a $399 billion a year total addressable market by 2028. Coreweave sits only at about $4 billion per year, which is really just about 1% of that total addressable market. So this is why people are really enthusiastic about Coreweave. Like, yes, Kevin, what you're saying is logical, but even if we have a fraction of that total addressable market that's being projected now, there should still be plenty of business for Coreweave. Worth knowing. And this is why I want to give you the pros and the cons. But this explains why there's so much enthusiasm for Coreweave right now, because their first earnings as a public company were good. And what they're saying in their earnings call reiterates why they're doing so well, why they have so much profit when you add back in depreciation, which a lot of people who take a first look at the earnings for Coreweave don't see the depreciation expenses, which are really write-downs to the IRS of paper write-downs. We don't necessarily have to see that decline in value of their assets. It's more of a tax play. People who understand depreciation know what I'm talking about. And of course, there's competition, Amazon competing through AWS, NVIDIA, DGX, they've got their own cloud service as well, Lambda Labs, Google Cloud, Microsoft, Meta, even XAI, right? There's a lot of competition here, so we'll see. But this is where I like Palantir, because see, Palantir could actually benefit from where AI is today. You don't actually need the latest and greatest models for Palantir, because Palantir uses what's known as ontological AI. This is a fancy way of saying Palantir organizes big data into ways that today's levels of AI can actually make sense of it. In their earnings call, for example, they give a description of a Walgreens executive recently highlighting that Foundry and AI Palantir allowed them to play AI-powered end-to-end workflows in 4,000 stores within 8 months, automating what amounted to 384 billion decisions every day if you were relying on humans. In other words, Palantir has this really beautiful positioning where you could take today's level of neural nets, organize data in a structured way, and help AI at today's levels analyze the information. This is why Palantir has gotten so exciting as a stock. Now, the valuation is high. We know that. This is not a video to bag on the Palantir valuation. And yes, there could be a lot of stock volatility both to the upside and the downside. But one of the reasons that I talked about part of the Palantir as being real AI, like I did not only on the YouTube channel here, but also here in November of 2023 as an example in this tweet, I wrote C3 AI dumping on news that employees were fired across departments last week, whatever. The comment I had on this is, in my opinion, Palantir is a much better play than C3 AI. Full transparency, I have long positions in Palantir in my ETF, but I don't in C3 AI. So basically they're saying like, hey, Palantir is your real AI, and like I'm putting my money where my mouth is on this. Big fan of that. Now, that said, again, valuation a little stretchy right now on Palantir, but we see Palantir still as a real AI player today, but also a long-term beneficiary. Think about this, and I love this. AI agents are processing vast volumes of intelligence reports in the Department of Defense, finding things humans miss, and AI agents are monitoring for sepsis at Tampa General Hospital, for example. Now, these are great deployments of artificial intelligence that don't rely on insane capital expenditures like what you're seeing by companies, less so now at Microsoft, but still at Amazon and Meta and even XAI to some extent, where are those really going to return investors' capital? The question there, I think, is valid. And I think it's reasonable why we've seen Palantir skyrocket so much, because you have a company that's not blowing a bunch of money trying to come up with the next greatest model. Instead, you have a company that's benefiting from what they've always done. Take big data at companies and make it more accessible. Now, one of the big things that's happened at Palantir, which I love from their last earnings call, is what I call the unlocking of artificial intelligence on a big data level. Now, let me explain what that means. Take a look at this screenshot here from their earnings call. And then I would say, culturally, we just don't see the resistance to the way we roll that we did in the past. We would show up in the past, the freak show, trying to get things to work, not with the wrong access to the wrong people at the wrong time. Well, I think this might be a improper translation here. I forget the word "not" there. I just read it as with the wrong access to the wrong people at the wrong time. And that was by intent. People were very uncomfortable at all levels of enterprise working with us. Basically, Palantir's describing that in the past, people didn't like handing over all their big data. The Department of Defense may not have been as comfortable. Hospitals may not have been as comfortable with their HIPAA-protected, customer data, basically. Now, listen to this. Now, we have full stack engaged with us, inside the government, outside the government, on most critical issues. I'm on the front line with everyone. 2 years ago, we might get a CEO, we might get a CIO, we might get someone in marketing, but they had no power. Today, everyone wants to work with Palantir, and they're like, please. It's like they're opening up their legs, going, please, take what you want. Have all of me. And if you think about that transformation, it shows you that when it comes to AI, we don't actually maybe need all of this exponential artificial general intelligence AI to make money with AI. We actually have this incredible growth that we have access to in encyclopedic AI that now is just a matter of putting that encyclopedic AI to use. And that's what companies like Palantir are doing. Now, of course, when we compare the profits that Palantir generates compared to Salesforce, which has a similar similar market cap to Palantir, but the valuations are insanely different. Palantir is trading for over a 7 to 9 peg, depending on what kind of forecast you give them, price to earnings growth multiple, right? It makes Palantir very rich and likely also the beneficiary of stock market momentum. But who says that stops anytime soon? I'm not making a projection on the price of Palantir. I'll tell you that I think it is actually fairly priced, closer to $40. But that's just based on today's growth numbers. My bullishness for the company, though, says that this is the kind of company that I have less risks of being a sort of a Coreweave bag holder with Palantir in terms of where the industry is going in the longer term. Although those risks could also be misplaced for Coreweave because, again, Coreweave is only addressing $4 billion of what's projected to be a $400 billion total addressable market in the long term. I also think Palantir's valuation is just undesirable at these levels, but in the long term, both of these plays could be really exciting investments. Who knows? If we go through some kind of Moody's downgrade credit shock, or if we go through a recession or whatever, I'm going to be paying attention to both of these companies. And if I had to pick one of the two to fundamentally just blindly believe in the long term in terms of which company is going to have more success for the long term, I'll take the fortress balance sheet and what Palantir is doing any day over the broken balance sheet at Coreweave, which is fixable, but they'll probably get themselves into the same situation again because of how fast they want to expand. Very, very capital intensive business. Palantir, on the other hand, again, we're working with the data that we have available today and the levels of AI that we have today, not necessarily relying on those next levels, just making use of what we have today. And I love that. I think it's less of a bet on future growth and more of a bet on, hey, we're really good at what we're doing and we actually don't need technology to improve. We just want to expand how great we are at what we're doing to more businesses, more parts of the government, and otherwise. It's one of the reasons why I also said I thought Palantir would be a beneficiary of Doge, and so far it seems like they have been because the government realizes Palantir actually makes you more efficient. This is where in their earnings call, Palantir tells us, hey, you make money when you spend money on Palantir. This is kind of cool. Now, in fairness, one of the downsides that you have for Palantir is I don't know how much markets are pricing in that Palantir is going to take over Europe in the future. Westpac actually had a little piece out where they say, given the recent behavior of the Trump administration on the USMCA deal, the rule of law, and defense issues, plenty of European and Canadian companies and governments may well be coming to the view that they do not want to be quite so dependent on US providers of defense systems, cloud computing services, and other specialized exports that the US has dominated up until now. Okay, that could be a little bit of a downside for Palantir because, see, CARP says that Europe just doesn't get AI yet, and at some point in the future they will, and basically will open up our market to Europe, keeping in mind that international commercial revenue declined 5% year over year at Palantir. Now, it's a smaller portion of the business. The US commercial side is 5.7 times the size of the international commercial side for Palantir, but it is worth paying attention that potentially Europe could be a little bit behind, and that people are excited about Europe getting involved. But then you also have this sort of international risk that maybe people won't want an American company. Who knows? I think in the long term, people will come back to America. That might be post-Trump. But, you know, a decade from now, as a very, very long-term investor, I kind of look forward to the opportunity I could get a really good buy the dip opportunity on Palantir, okay? So I'm not saying that to be bearish. I'm just saying that valuation gets cleaned up a little bit and there's some shock in the market. This is a pretty juiced company to invest in, okay? It's great because we're not making crazy CapEx bets and assuming that Meta is going to continue to throw $60 billion a year on AI data centers. You just don't have as much of that risk. My take. Anyway, there you have it for Palantir versus Coreweave. Now,